Empires, inventions, corporations, all fell the same way. Not by accident, by design. WeWork's liabilities were locked in for 15 to 20 years. Its revenue could walk out the door with 30 days' notice. That mismatch was not a risk the company failed to manage. It was the business model itself, and it guaranteed the outcome before the first employee was hired. Every collapse this channel examines has a moment of origin, a decision, a signature, a contract, where the ending is already written. For WeWork, that moment came when Adam Neumann and his co-founders realized that commercial landlords sitting on empty floors after the 2008 downturn would sign long-term leases at depressed rates just to fill vacant space. Neumann's insight was not technological, it was arbitrage. Lease large blocks of office space cheaply for 15 to 20 years, then subdivide and re-let that space to freelancers and small companies on flexible, short-term terms at a significant markup. The spread between what WeWork paid landlords and what it charged tenants was the entire business. On paper, this looked defensible, even elegant. Commercial office demand was rising through the 2010s. WeWork could point to occupancy rates, to revenue per member, to a growth curve that climbed year over year. JPMorgan helped underwrite the story to institutional capital. SoftBank, through Masayoshi's son and the Vision Fund, poured in capital at valuations that assumed WeWork was a technology platform. Something with software margins, network effects, and exponential scaling. The name itself, We Company, was engineered to suggest community and software, not commercial subleasing. Wall Street and private investors accepted this framing largely at face value because the alternative reading, that this was a real estate company with technology company risk tolerance, would have demanded a completely different valuation model, one with hard ceilings. That alternative reading was the correct one, and it exposes the exact mechanism this channel exists to document. Here is the flaw, stated with precision, not as a warning sign missed in hindsight, but as a structural condition visible in every lease WeWork signed. On one side of the ledger, fixed obligations, 15 to 20 years in duration, in some early cases, personally guaranteed by Neumann himself, later scaled into corporate guarantees as the company expanded into hundreds of buildings across dozens of cities. These obligations did not flex. They did not shrink in a downturn. They accrued whether or not a single desk was occupied. On the other side of the ledger, revenue from tenants who could terminate with 30 days' notice. Tenants whose commitment to WeWork was, by design, the opposite of WeWork's commitment to its landlords. This is not a risk factor in the way currency exposure or supply chain delay is a risk factor. Those are variables that can move against a company. This was an architecture that was short volatility by construction, a system that required continuous, uninterrupted revenue growth simply to service liabilities that did not care whether growth continued. And the company did not slow down to test this exposure. It accelerated into it. The years when WeWork most needed to demonstrate that its unit economics could hold, building by building, lease by lease, were the exact years it signed the largest volume of new long-duration liabilities, expanding into Asia, into Europe, into markets where local demand for flexible office space had not yet been proven. Each new lease was another 15 to 20-year liability stacked onto a revenue base that remained, structurally, 30 days deep. This condition did not go unnoticed because it was invisible. It went unaddressed because it was subsidized. For years, SoftBank's capital injections absorbed WeWork's operating losses before those losses could force a reckoning. Every funding round bought time, and every funding round was priced not against the durability of the lease obligations, but against a growth narrative. Square footage under management, membership counts, geographic expansion, that substituted for the harder question of whether any individual building was profitable on its own terms. Private valuations, set by the Vision Fund's internal markups, insulated the company from the kind of scrutiny public markets apply automatically. A private company can describe its trajectory. A public company has to publish its balance sheet. This kind of failure is not an accident. It is a pattern. Subscribe if you want to keep seeing how it is built in. That published balance sheet arrived in August of 2019 when WeWork filed its S-1 registration statement ahead of a planned initial public offering. The filing did not create the mismatch between long-term lease liabilities and short-term revenue. It disclosed it for the first time to an audience with no incentive to accept the growth narrative on faith. Analysts and journalists read the same numbers that had existed on WeWork's internal ledgers for years. Billions in future lease obligations set against a business whose actual revenue commitments were rolling and thin, and reached the conclusion that private capital had been declining to reach. The S-1 also surfaced Neumann's governance structure, his control through super voting shares, transactions in which he personally profited from leasing buildings he owned back to the company he ran. That self-dealing accelerated the collapse in public perception. But it was accelerant, not root cause. The lease architecture was already terminal. Neumann's conduct simply removed the remaining reasons to look away from it. Within weeks, the IPO was withdrawn. Neumann was removed. SoftBank took control of the company at a valuation cut by tens of billions of dollars from its private market peak. But none of this altered the underlying structure. It only removed the mechanisms that had been concealing it. This is not a mechanism unique to WeWork. In 2003, Regus, a company built on the identical model of signing long-term commercial leases and subletting flexible office space on short-term terms, filed for bankruptcy protection in the United States after an economic slowdown, reduced occupancy, and its fixed obligations remained exactly as fixed as they had always been. Regus survived, restructured, and later rebuilt itself as IWG. But the mechanism that broke it in 2003 was the same mechanism that broke WeWork 2 decades later. Borrow long, rent short. It is the same architecture that produced the savings and loan crisis in the American banking sector in the 1980s, where institutions held long-term fixed-rate assets funded by short-term, rate-sensitive deposits. Different vocabulary, different regulators, same structural asymmetry. When the environment shifts, when rates move, when demand softens, when growth simply slows rather than accelerates. The long-duration liability does not renegotiate itself. It waits. It is the only party in the arrangement that does not have 30 days' notice. WeWork filed for Chapter 11 bankruptcy. Protection in November of 2023. The filing listed billions of dollars in long-term lease obligations as its primary liability. The same category of instrument, the same durational structure that had made the arbitrage model function in its very first year of operation. The mechanism that built the company and the mechanism that ended it were never two different things. They were the same clause, read at two different points in time.